Hey, Steve Saretsky here. As always, there's a couple blog posts to go with this video, so you can find those in the description below. It's going to reference you some graphs, some charts, and data that I always like to include in all these videos. I don't like to just spew a bunch of facts or BS or whatever and not have anything to back it up. Obviously I don't pretend to be an economist or a stock guy or predict markets, simply to provide you with some of the information that I seek. I mean, I'm probably reading, financial news 2-3 hours a day minimum. Always just trying to absorb and study. And I think one of the markets that I study particularly is credit cycles, credit markets. That's stuff that really interests me, and I think that plays a huge factor into the real estate markets, particularly in Vancouver, Toronto. And so anyways, what I want to talk about today was really about credit in the system. Interest rates. Obviously, if you're watching the news today, the Bank of Canada kept their interest rates firm at 0.5%. If you've been watching it, this is really important for the housing market, because ultimately lower interest rates, the cheaper the money, it really encourages speculative demand. And I know Better Dwelling wrote a post on that, so I'll try to link that in here as well. But this cheap money ultimately fuels people again into housing, and ultimately pushes prices up. And you can say, well, the mortgage payments are lower because the interest payments are lower, etc. But ultimately, you're putting all this debt into the system, and the higher the debt, I mean, ultimately, when you go to raise interest rates, it's that much more difficult to service the debt. You eventually have this painful deleveraging process where you try to get rid of all that bad debt. Of course, that's what we saw in 2008, 2009 in the United States. Is interest rates started to go up, and basically things fell apart. People couldn't afford mortgages, etc. And so you have this painful deleveraging. So they get rid of a lot of their bad debts. What happened in Canada was basically, instead of really getting rid of our bad debts, we actually went on more of a borrowing spree, increased our debt levels, increased the credit into the system. Of course, this ultimately helps to push up prices. Again, as I keep saying, anytime you have house prices go up 50% in Vancouver over the last 2 years, and wages are essentially stagnant, you have to do the math. It's essentially the only way to sustain that is with more leverage in the system, which means a bigger mortgage. Which really brings me to another interesting point. Just talking about the mortgages again, I've written a post about this last week about mortgages deteriorating, the quality of mortgages deteriorating in Vancouver. Better Dwelling got some of the statistics from the Bank of Canada, and basically the loan to income ratios are shooting through the roof. They're above 450%, which is beyond healthy in certain areas. I think Marpole in Vancouver was one of the areas. But again, basically the premise is, of course, when prices go up, the only way to really sustain them is either through wage growth or really through a bigger mortgage. So when you have condos in Abbotsford going up by, I believe it's 38% now year over year. Condo in Langley, I think, is up about 33% year over year. Again, these are areas primarily where it's hard working locals, where we really haven't seen much wage growth. And so for these prices to be able to go up and sustain, again, it really just comes on from taking on more leverage. It's very interesting. People can say we don't have subprime here. Again, we don't really, the extent of it, we don't really know. You never really know until, the old quote says, you don't know who's swimming naked until the tide goes out. So we don't really know the extent of it. Of course, we've seen things like home capital come up. Again, people will say, well, how much of it is fraudulent? How much of it is subprime? I would certainly think that there's a pretty big factor based on my conversations. Just speaking with a friend over the weekend who's in the residential mortgage underwriting business, who has now switched over into the commercial side. He's with one of the credit unions, but he was telling me that the amount of debt that he's seeing some of these people getting into was really, for him, it was mind-boggling. That basically in 2016, this credit union hit their targets in 4 months for the year. They hit their entire targets for the year in 4 months, and then they eventually shut down their mortgage broker channel basically midway through the year, because they said that there was just too much volume. The housing market was out of control. They couldn't sustain it. Things were just totally out of control, so they shut it down. But he was basically just telling me that basically what a lot of people are doing. This is what I've been seeing feet on the ground as well. So it really doesn't come as much of a surprise to me, but it's always, once you start to get, stories from other people that sort of confirm your theory, is that a lot of these people, especially like you have to look at first-time buyers, mom and pop investors, so relying on the equity of their existing home to basically funnel that, to use that as a, taking out home equity lines of credit, using that as the down payment, taking out these lines of credits, and then as soon as your house price goes up, they then take out the line of credit on that one to pay down the existing one. And it's almost like this continuous Ponzi scheme that, again, that is all predicated on house prices continuing to rise. So as soon as you basically see a stagnation, that's where that money scheme almost it dries off. So, again, I always say all this not to discourage anyone from getting into real estate or whatever, but I always just say to look at these gains, to look at Langley condos going up by 33% or Abbotsford by 38%, and just seeing all these people, taking out home equity lines of credit, using that as the down payment and buying 2, 3, 4 condos with it, expecting that these returns are going to continue. I mean, really, it is totally irrational. If you're buying a primary residence to live in for the next 5, 6, 7, 8 years, and by all means, go ahead. Money is cheap. It's basically it's basically the cost of inflation. You got to live somewhere. You could argue it's better than renting. I certainly think it is. Then it makes sense. But it's these people that are investing and they're going, oh, this is great, and it's never going to end. 10, 15, 20% gains every year. It's I think it's just a bad strategy, and it leaves you extremely vulnerable. And like I said, it's almost this never-ending Ponzi scheme. So anyways, just going back, talking about the Bank of Canada, again, holding their key interest rate at 0.5%. There's been a lot of scrutiny coming towards them, and a lot of these economists are saying that they gotta hike, and they're not in a position to hike because the economy is so weak. It's all reliant on house prices. That's what's driving the growth, and so they're saying, well, that you should hike because you have these housing bubbles in Vancouver and Toronto that you really need to sustain. Of course, Calgary's starting to take off now. There's hints of maybe Montreal's the next one. This is almost just going to go city to city until they can really, and the people say it's too blunt of a tool, raising interest rates, etc. But the fact of the matter is that when you have this low money, this cheap credit in the system, it just encourages people to spend. Why would you keep your money in the bank when you're getting paid 0.5%, in a tax-free savings account versus, being able to borrow at 2.5%, inflation's roughly 2%. I mean, again, it's just encouraging people to jump into the housing market. So they're saying that the Bank of Canada should hike these interest rates. Anyways, they've kept firm based on, they're saying, first of all, it's a politically terrible move. If you're the Bank of Canada, the governor, Stephen Pelosi, you have to think about it from his perspective. None of these politicians, the Bank of Canada, none of them want to be responsible for the people that deflate a housing bubble, that put an end to this growth, to this. Obviously, a lot of people become wealthy off it. Obviously, there's so much debt in the system that nobody wants to be responsible. They'd rather just sort of let it happen on its own. So they basically keep going back to this, we haven't hit our 2% mandate inflation CPI, but that CPI you could argue I would argue is questionable at best. Their CPI, they weight housing, I believe, at 26% of the CPI housing makes up. So they basically look at the CPI, essentially looks at how much do things cost. How much is how much does a car cost, how much is your housing cost, how much is food costing, etc. And they factor this all in, so they're aimed for 2% inflation. And so they're saying, based on their CPI, they said in Canada, house prices only went up by, I think it was 2.6%. So again, we know that. So 2.6%, again, in Vancouver, over the last 2 years, it's about 50% increase. Toronto, I think it's 33% year over year. So we're having massive inflation. It just doesn't fit into their CPI models. And so, again, you can question the models, you can call it whatever you want. You can say that the Canadian economy isn't in a position to hike rates, which I agree they're not. But at the same time, do the pros outweigh the cons? You're creating these massive bubbles that ultimately you're creating a massive debt, and ultimately, this debt, it eventually has to be serviced. You can talk about the debt service ratios, but ultimately, when interest rates eventually rise, that debt does not just go away. It has to be paid, and it's going to end up getting serviced at a higher interest rate. So, you can hike now, or you can hike in a year or 6 months or 2 years. It doesn't matter. At the end of the day, the debt has to be paid. At the end of the day, the longer that you drag it out, the worse it's going to be. So I think that's sort of the resounding message. It's just hike the interest rates. Let's get it over with. Let's wipe out this bad debt, and let's restart here. But that's not what they want to do, again, for political reasons, and of course their mandated CPI of 2% inflation, that technically it's not the Bank of Canada's job to, correct asset bubbles or whatever. So anyways, again, this is, and just to add to that is, a lot of people talk about is, I think there's also this conception, and again, you can agree with it, disagree with it, but I hear a lot of people talking about it, is that, oh, well, the housing will continue to go on as long as the Bank of Canada keeps their interest rates where they're at. They got a hike, whatever. But interestingly enough, again, I study the credit cycles. You can believe it. Some people that I read or not. I just like to put this information out there for people to interpret. And again, always, form your own opinions and biases on it. But just reading Professor Steve Keen, who I've talked about a lot, a really smart economist. He just wrote another book. This one says, Steve Keen's "Can We Avoid Another Financial Crisis?" The book sounds doomy gloomy, but it's not a one-word answer book. It goes into very big detail, and basically talks about credit cycles and the debt that's in the system. And it actually says that it's not for house prices to come down, or for credit to start leveling off, etc., for the economy to slow. It doesn't actually need an interest rate hike. It actually just needs a slowdown in the acceleration of credit growth. And so he's labeled all these charts. Household debt, again, in Canada, it's the highest in the G20. So he looks at Canada, Australia, China, and he looks at all these economies and says, okay, well, why they really didn't have much of an economic shock in 08, 09, because essentially they borrowed their way out of it. They increased their household debt levels, and they're really at a point now where eventually you hit a ceiling. There's only so much debt you can pump into a ceiling. There's only so much debt that people are willing to take on. And so basically, as the acceleration of credit slows down, he believes that's when when house prices start to taper off. And then it's that, it's that circle, that vicious circle that sort of ensues, right? So again, obviously, as house prices level off, it's that sort of scheme that I was talking about earlier is, banks aren't going to give you that home equity line of credit, or that home that you just bought to pay down that other loan that you took out to use as the down payment. There is no house price growth, so now you don't have that ability, right? So it's just, again, a lot of the system is basically predicated on house prices going up. And so basically, to summarize out of it, is the Bank of Canada kept rates firm today. What it means, it's probably a more positive thing for house prices if you want to keep them going. But again, ultimately, at the end of the day, whether you believe it or not, I think Steve Keen's work is good. I do believe in that it's not so much that interest rates, but it's the acceleration of credit growth. And so that's why I look at alternative lenders like, Home Capital Group. So people say they only make up 2% of the industry. But at the end of the day, that 2% starts to affect, other lenders, and even to take away 2% of credit growth. Again, that's slowing down some of that credit growth. You can say it's certainly other lenders. Again, talking to some of my mortgage friends, is that, banks are starting to tighten up a little bit. And so as that dial starts to tighten, you just look for these sorts of things. And again, so, this is what I like to study. I like to study credit cycles. I think it's very interesting. I don't by any means try to be the expert. I just like to educate people based on what I'm studying. I try to provide as much, data and graphs, etc. as I can. And again, as I always say, this isn't to deter anyone, as people always say, oh, Steve, you're deterring. No. I've worked with a lot of buyers this year, and it's always just about educating people to say, you know what, if you're going to get into a house and maybe it's a long-term hold and you have the money, or it's a primary residence and you're borrowing at 2.5%, where money's never been cheaper, and you're willing to ride the ups and the downs of the market, by all means, get in. It's more so the people that, again, that are leveraging themselves, that are thinking that this is going to continue to go on, that this is 10, 15, 20% price gains year over year are sustainable. Again, you've had this very long, prolonged credit cycle. It's reaching its ceiling. At the end of the day, the Bank of Canada can hold out as long as they want, but it's a slowdown and acceleration of credit. It's other external factors. You look at the United States, which is tightening. The Fed's starting to offload their balance sheet. They're looking at an 80% chance of a rate hike again, I believe, in June. There's only so long that the Bank of Canada can hold out. There's only so long this credit can go up. And again, you can talk about debt service ratios, but at the end of the day, interest rates, even if they only go up a couple of quarters of a point, eventually this debt needs to be repaid. And this is just some of the factors that I look at. I know that I'm probably rambling on, but hope that helped. I'll put as many links as I can in the description below. Feel free to subscribe. What else? I got a real estate event coming up here on Saturday, May 27th in Vancouver. It's a free event that I'm putting on with a couple of investment advisors in Vancouver, 10 a.m. So I'm going to put a link to that. You can actually jump onto our site to get tickets for that. Basically, it's a free event. I'll basically just be talking about Vancouver real estate, everything that I see in the market. It's technically geared towards downsizers, people that are looking to downsize and use their equity. So these investment advisors are essentially, call whatever you want. I don't think there's going to be any hard pitch. There certainly won't be from my side. But basically, looking at people to cash out, saying, I think certainly this is a good time, seeing detached house prices going up by, again, 50% in the last 2 years. If you're an older person looking to downsize, I certainly think it makes sense. Also, be painting that picture, going through some of the data, and then these guys are essentially going to be coming in and saying, hey, this, if you're going to downsize and buy a condo and you got $1 million left over, this is sort of where we advise you to use your money to create sort of a portfolio, which is going to create, a monthly dividend, passive income, that sort of thing. So we think it's going to be a good event. Obviously, we still got some tickets left to go. They're free. The event's free. And so if you want to jump in on that, again, you don't have to this isn't like you got to come and sign up for anything. Just come and learn. And if you know anyone that wants to go, send them a link. And again, that's all in the description below. So, all right, I hope that helped, and talk to you soon.